Welcome to lesson 12 of the Value Investing Bootcamp. Are you still having fun? Good. Then let us move on to a very interesting and useful topic, financial ratios. Financial ratios are what you get when you combine some figures from the financial statements in smart ways. Why would you do this? Well, because these ratios allow you to compare companies regardless of how big or small they are, and get a better idea of how well they are performing. This lesson will cover some of the most important financial ratios for value investors. Here we go. Possibly the most often used financial ratio is the earnings per share, or EPS. This is an interesting ratio because it shows you how much profit a company is making for each stock it has issued. Remember from the previous lesson how a company reports its net income on the income statement? Well, to calculate the earnings per share, we simply take this bottom line net income figure and divide it by the amount of shares a company has issued. This is often called shares outstanding. You can find this number on many financial websites like Google Finance, Yahoo Finance, or Guru Focus. This earnings per share figure can then be used to calculate another common ratio, called the price-earnings ratio, or PE ratio. It is a valuation ratio, or a multiple, since it shows you how much investors are willing to pay for a stock per dollar of income. In general, a high PE ratio indicates that investors expect high future growth rates. What is a high PE ratio, you may ask? Well, this differs greatly per industry, since not every industry has the same growth prospects. However, the average historical PE ratio of the S&P 500 is 15. To calculate the PE ratio, simply divide a stock's current share price by its earnings per share figure. While the PE ratio is interesting to look at, PE in itself does not say much about whether or not a company is undervalued with respect to its intrinsic value. Also, PE ratios differ greatly per industry, and thus you potentially exclude perfectly sound investment ideas if you filter stocks based on their PE ratio. So do not put too much emphasis on PE, but be wary of companies with extremely high PE ratios. In the previous lesson we talked about top-line revenue and bottom-line net income. If we divide net income by total revenue, we get a ratio called the net margin. This net margin ratio tells you what percentage of total sales is translated into bottom-line profits. If a company has a high net margin, this means that for every dollar of sales, a relatively high percentage is translated into net income. This is the case for companies which are able to keep their costs low or are able to charge premium prices to their customers. Companies with high net margins often attract competitors, which slowly eat away at their profit margins. Therefore, if a company is able to sustain high profit margins for an extended period of time, this might be an indication that a company has something unique which cannot be easily copied by competitors, like a strong brand name or patented products. However, just as with the PE ratio, the net margin differs greatly per industry. Some companies make plenty of money with a 5% profit margin, while some technology companies sport net margins in excess of 20%. So use it with care. Still, a low profit margin is relatively more dangerous because it leaves less room for error. If the costs of a company with a low net margin suddenly increase, this might be enough to completely wipe out a company's profits. In such a case, even a slight bump on the road could mean the difference between profit and loss. Looking at earnings alone does not tell you the whole story, because even if two companies have the same earnings, this does not tell you anything about the capital that is required to generate those earnings. Remember shareholders' equity from the previous lesson? Shareholders' equity is an indication of how much money has been invested into the company. Imagine two companies both earning the exact same net income. However, Company A requires only half the amount of equity Company B needs to generate this level of income. This means that Company A uses its equity investments more efficiently. It indicates that every dollar invested in Company A will generate twice as much extra net income as that same dollar invested into Company B. This is huge. This important ratio between net income and shareholders' equity is called the return on equity, or ROE. To calculate ROE, divide net income by shareholders' equity. Let's step away from earnings for a minute and take a look at a company's shareholders' equity per share, which is more often called book value per share. I know, it's very annoying they keep switching those words around, but unfortunately that's the way it is. In theory, the book value per share shows you how much money you will receive per share if a company would liquidate, or in other words, the amount of money that is left after a company sells all its assets and pays all its debts. However, we already discussed in previous lessons that book value is an accounting term which usually does not accurately reflect the true value of a company's assets. So why should we bother to look at book value per share at all? Well, even though book value per share is often inaccurate, the development of this value over time is still very interesting for value investors, because it gives you a general sense of whether a company is creating value or destroying value. You want to look for companies with a steadily increasing book value per share, because these are the companies which are creating value. To calculate the book value per share, divide shareholders' equity by shares outstanding. The next ratio also uses shareholders' equity, but combines it with the amount of long-term debt a company has reported on its balance sheet. If we divide total long-term debt by shareholders' equity, we get the so-called debt-to-equity ratio. This ratio indicates how much debt a company has in relation to equity. The higher the debt-to-equity ratio, the more the company relies on debt to finance its growth. A high debt-to-equity ratio is a warning sign for value investors because it indicates that a company has to pay significant interest expenses. These interest expenses do not only cost the company money, but they also leave a company vulnerable to interest rate changes. They are often unpredictable. In addition, high debt levels can significantly inflate the return on equity ratio we just discussed, making this metric less accurate and therefore less useful. If debt is used in a productive way, however, it can produce significant amounts of extra income. Still, you should prefer companies with low debt levels over companies with high debt levels. We now looked at the profitability of a company, its ability to create value, and its ability to pay its long-term debts. What else do we want to know about a company? Well, what about its ability to pay its short-term bills? One ratio that can be used for this is the current ratio. The current ratio is a liquidity ratio, which measures a company's ability to pay its short-term obligations, or in other words, a company's ability to pay its bills, which have to be paid soon. To figure this out, we need to combine two balance sheet items, current assets and current liabilities. Examples of current assets are cash and short-term investments, which can be easily sold. Current assets are used to fund day-to-day operations. Current liabilities are all the bills a company has to pay within a short period of time, usually in less than a year. We calculate the current ratio by dividing current assets by current liabilities. What you want is a company which has way more money than bills, so the current ratio should be at least 1, but preferably 2 or higher. You can find the formulas and explanations for all these ratios in the glossary document, which is part of this module. To summarize, financial ratios allow you to compare companies and get a better idea of how well they are performing. Earnings per share shows you how much profit a company is making for each stock it has issued. The price-earnings ratio is a valuation ratio, or multiple, which shows you how much investors are willing to pay for a stock per dollar of income. PE in itself does not say much about whether or not a company is undervalued with respect to its intrinsic value. The net margin tells you what percentage of total sales is translated into bottom-line profits. Both PE and net margin differ greatly per industry, which makes them unsuitable to compare companies across industries. Return on equity shows you how much net income a company earns per dollar of equity, or in other words, how efficient a company uses its equity to generate profits. While book value is often inaccurate, the growth of book value per share over time gives you a general sense of whether a company is creating value or destroying value. The debt-to-equity ratio indicates how much debt the company has in relation to equity. High levels of debt are dangerous because the interest payments can bankrupt the company. The current ratio is a liquidity ratio, which measures a company's ability to pay its short-term obligations. Okay, you just learned some of the most useful financial ratios. You may have noticed that many of the ratios we discussed are related to net income. However, net income is an accounting measure which can be fairly easily manipulated by managers. Therefore, we'll cover an important measure of profitability in the next lesson, which is much harder to manipulate: free cash flow.